One family built one of the largest fortunes in American history, and within 3 generations, almost all of it had simply disappeared. The family name was Vanderbilt. It began with Cornelius Vanderbilt, born in 1794, who started his career as a teenager ferrying passengers and cargo around New York Harbor in a small boat. Through relentless ambition and ruthless competitive instincts, he built an empire first in shipping, then in railroads, eventually amassing a fortune worth roughly $100 million by the time he died in 1877, an amount so large it represented a genuinely staggering percentage of the entire nation's wealth at the time. Cornelius left the overwhelming majority of that fortune to a single son, William Henry Vanderbilt, specifically because he believed splitting it evenly among all his children would dilute the family's economic power. William doubled the fortune within just a few years through continued shrewd management of the family's railroad holdings, leaving behind a family that was, by any measure, among the wealthiest in the entire world. Morgan Housel has written that building wealth and keeping wealth require almost entirely different skills. The aggressive risk-taking and relentless ambition that build a fortune are often the exact opposite of the patience and restraint required to preserve it across generations. The Vanderbilt family's story became one of the starkest illustrations of that gap in American history. The generations that followed Cornelius and William inherited enormous sums of money without inheriting the specific hunger, discipline, or first-hand understanding of risk that had actually built the fortune in the first place. Many Vanderbilt heirs became known less for business acumen and more for extraordinary spending, building some of the largest private homes ever constructed in America, including the Biltmore Estate in North Carolina and multiple mansions along Fifth Avenue in New York, along with lavish social lives that prioritized visible status over the kind of ongoing productive investment that had generated the family's wealth in the first place. Benjamin Graham's investment philosophy emphasized understanding exactly how wealth is generated and maintained, rather than simply enjoying its visible trappings. Many of the Vanderbilt heirs appear to have understood the second half of that equation far better than the first, comfortable displaying wealth, far less equipped to actually manage or grow the underlying assets that produced it. Daniel Kahneman's research into how people relate differently to earned versus inherited resources helps explain part of what happened across the Vanderbilt generations. Money that's earned through direct personal effort tends to be handled with a caution shaped by first-hand experience of how difficult it was to obtain. Money that simply arrives through inheritance often lacks that same instinctive caution, since the recipient never personally experienced the specific difficulty of building it from nothing. By 1973, less than a century after Cornelius Vanderbilt's death, a family reunion was reportedly held at Vanderbilt University without a single millionaire in attendance among the descendants who gathered, a detail frequently cited in accounts of the family's decline, illustrating just how completely one of history's largest fortunes had dissipated across just 3 or 4 generations. Robert Kiyosaki's core lesson about the difference between assets and liabilities applies with unusual clarity to the Vanderbilt story. Many of the family's later expenditures, the mansions, particularly, functioned as enormous, ongoing liabilities rather than productive assets, requiring continuous maintenance, staff, and property taxes that steadily drained family wealth without generating any offsetting income in return. Here's an honest complication worth including. Since the shirt sleeves to shirt sleeves in 3 generations, narrative sometimes gets told with more precision than the historical record actually supports. Not every branch of the Vanderbilt family lost everything, and some descendants, including figures like journalist Anderson Cooper, have spoken publicly about growing up without direct access to the historical family fortune specifically because it had already been distributed and dispersed across so many branches and generations by the time they were born, rather than because every single Vanderbilt heir personally squandered their share through reckless spending. George S. Clason's advice about protecting and continuing to grow accumulated wealth assumed each generation would actively maintain that same discipline going forward. The Vanderbilt family's decline illustrates what happens when that assumption fails, when the specific values, habits, and understanding that built a fortune aren't successfully passed down alongside the money itself. This isn't a simple story suggesting inherited wealth is always destined to disappear, or that every wealthy family eventually repeats this exact pattern. Plenty of family fortunes have been successfully preserved and grown across many generations through deliberate structures and shared values. What makes the Vanderbilt story worth remembering is how starkly it illustrates a real, documented pattern. The skills required to build a fortune and the skills required to preserve it across generations are genuinely different, and money alone, without the mindset that created it, has no guarantee of lasting. So here's a question worth sitting with. If you built significant wealth today, would the values and habits that built it actually transfer to the people who might eventually inherit it, or just the money itself? Before you leave, I want to hear from you. Have you ever seen wealth, or any other resource, disappear specifically because the habits that built it weren't passed along with it? Read a few comments before you go. Some of the most thoughtful reflections on this channel come from people who've watched exactly this pattern play out across their own families. Next week, I'll pick one comment and send its author one of the books that inspired this channel. And if these stories help you think differently about money, you'll find a way to support future research in the description. Every contribution helps buy books, access research, and keep this content free for everyone. Remember this. The Vanderbilts didn't lose their fortune because the money ran out on its own. They lost it because the habits that built it were never fully inherited alongside it. In 2000, two men sat across a conference table from executives who could have bought their entire company for $50 million, and laughed them out of the room. The two men were Reed Hastings and Mark Randolph, co-founders of a small, struggling DVD by mail startup called Netflix. The executives were from Blockbuster, at the time the dominant video rental chain in America, with thousands of stores and billions of dollars in annual revenue. Netflix, in 2000, was nowhere close to the company it would eventually become. It was burning through cash, struggling to grow subscribers fast enough to justify its costs, and looking for a way out of an increasingly difficult financial position. Hastings and Randolph flew to Dallas to pitch Blockbuster's leadership on an acquisition, proposing that Blockbuster buy Netflix outright and let it operate as Blockbuster's online rental division. By most accounts of the meeting, Blockbuster's executives treated the pitch as barely worth serious consideration. Netflix, at the time, had a relatively small subscriber base, and Blockbuster's leadership reportedly viewed the entire DVD by mail model as a niche curiosity rather than a genuine threat to their thousands of physical stores and the enormously profitable late fee revenue those stores generated. Morgan Housel has written that the businesses most vulnerable to disruption are often the ones whose current success depends on the exact thing the disruption is designed to eliminate. Blockbuster's profitability was deeply tied to late fees, charges customers paid for returning rentals past the deadline, reportedly making up a significant portion of the company's overall revenue. Netflix's entire model, built around no due dates and no late fees, wasn't just a different way to rent movies. It was a direct attack on the specific revenue stream Blockbuster's business had grown to depend on. Benjamin Graham's investment philosophy emphasized evaluating what a business is actually worth based on its underlying fundamentals, not simply its current market position or reputation. Blockbuster's executives, by most retellings, evaluated Netflix based on its current, modest size rather than the trajectory of the model it represented, a mistake in judging genuine underlying value, made by a company that had every resource available to make a more careful assessment. Daniel Kahneman's research into how people evaluate risk and status quo bias helps explain part of why Blockbuster's leadership dismissed the offer so completely. Blockbuster was, at the time, an enormously successful, dominant company. That very success may have made genuine, objective evaluation of a small, and profitable competitor's long-term potential significantly harder. Success creates a kind of confidence that can make leadership less likely to seriously imagine their own current model becoming obsolete. Netflix survived, adjusted its strategy, and eventually pivoted from DVD by mail toward streaming video as internet infrastructure improved throughout the 2000s. Blockbuster, meanwhile, continued relying heavily on its physical store network and late fee revenue model for years, making some attempts to compete online but never fully committing to a strategy that would have required cannibalizing its own existing, profitable business model, a pattern with clear echoes in Kodak's own reluctance to fully embrace digital photography. Robert Kiyosaki's core lesson about understanding what actually generates an asset's income applies directly here. Blockbuster's real asset, in the executives' minds, was its network of physical stores. What they failed to fully recognize was that the actual value driving their business, convenient access to entertainment, could eventually be delivered in an entirely different form that made the stores themselves increasingly unnecessary. By 2010, Blockbuster filed for bankruptcy, unable to compete with the streaming model Netflix had grown into over the preceding decade. Netflix, the company Blockbuster had turned away for $50 million, eventually grew into a business worth well over $100 billion at its peak, becoming one of the most successful entertainment companies in the world. Here's an honest complication worth including, since this exact meeting is sometimes retold with slightly different details depending on the source. The precise $50 million figure and some specifics of the exchange come primarily from accounts told years later by Netflix's own co-founders, and Blockbuster's side of the story has never been as thoroughly documented from their own internal perspective. The core outcome, Blockbuster passing on an opportunity to acquire Netflix early, and later collapsing as streaming displaced physical rental, is well established, even if the exact dialogue in the room has been somewhat dramatized in the retelling. George S. Clason's advice about recognizing genuine opportunity when it appears applies here as a cautionary counterexample. Blockbuster had the resources, the market position, and the opportunity to acquire the very technology that would eventually replace it, and chose instead to protect a business model that already felt comfortable and proven. This isn't a simple story about one company being smart and another being foolish. Blockbuster's decision made a certain kind of sense given what was actually known and visible in 2000. Netflix's own survival and eventual pivot to streaming was far from guaranteed at the time either. What makes this story worth remembering is the specific pattern it illustrates. Sometimes the businesses best positioned to see a disruption coming are also the ones with the least incentive to take it seriously, because acknowledging it clearly would mean threatening the very model that's currently working. So here's a question worth sitting with. Is there something in your own field, career, or habits right now that you might be dismissing simply because taking it seriously would mean admitting your current approach needs to change? Before you leave, I want to hear from you. Have you ever dismissed an opportunity or a warning sign because your current situation felt too comfortable or successful to take it seriously? Read a few comments before you go. Some of the most honest reflections on this channel come from people who've recognized exactly this pattern in their own decisions, sometimes too late. Next week, I'll pick one comment and send its author one of the books that inspired this channel. And if these stories help you think differently about money, you'll find a way to support future research in the description. Every contribution helps buy books, access research, and keep this content free for everyone. Remember this. Blockbuster didn't fail because nobody warned them about Netflix. It failed because the people who could see it clearest had the least reason to take it seriously. A hedge fund staffed by 2 Nobel Prize winners and some of the most sophisticated financial minds in the world nearly collapsed the entire global financial system in 1998, using math that was, by most technical measures, correct. The firm was Long-Term Capital Management. Founded in 1994 by a group that included legendary bond trader John Meriwether, along with economists Myron Scholes and Robert Merton, who would go on to share a Nobel Prize in Economic Sciences in 1997, partly for work underlying the very trading strategies their fund employed. LTCM's approach was built on incredibly sophisticated mathematical models designed to identify tiny, temporary pricing inefficiencies between related financial instruments, bonds that should theoretically trade at nearly identical prices but occasionally drifted slightly apart due to short-term market friction. The fund would bet that these tiny gaps would eventually close, capturing a small profit each time. The problem was that these individual price gaps were so small that meaningful profit required enormous scale and, crucially, enormous leverage, borrowing vast sums of money to amplify what would otherwise be a tiny, unremarkable return into something genuinely lucrative. At its peak, LTCM controlled positions worth over $1 trillion. Built on a base of only a few $1 billion in actual capital. Morgan Housel has written that financial models built on historical data can be extraordinarily precise about the past while remaining almost completely blind to the specific, unprecedented way the future eventually decides to misbehave. LTCM's models were built on decades of historical market relationships. What they hadn't accounted for was a scenario where multiple unrelated markets around the world would panic simultaneously, for reasons the models hadn't been designed to anticipate. In 1998, Russia unexpectedly defaulted on its government debt, triggering a global panic that spread rapidly across markets LTCM's models had assumed were only loosely connected. Investors around the world rushed towards safety at the same time, causing exactly the kind of correlated, simultaneous market movement that LTCM strategies depended on never happening. The tiny pricing gaps the fund had bet would close instead widened dramatically, and because the fund was so heavily leveraged, even a relatively modest adverse move translated into catastrophic losses. Benjamin Graham's investment philosophy emphasized a margin of safety, building enough of a buffer into any investment that even being partially wrong wouldn't lead to disaster. LTCM's entire strategy operated with almost the opposite assumption. Extreme leverage meant there was essentially no margin of safety at all if the underlying models turned out to be wrong about even one significant scenario, and in 1998, they were. Daniel Kahneman's research into overconfidence explains part of why some of the smartest people in finance built a strategy this fragile in the first place. The fund's founders had genuine, world-class expertise, and that expertise appears to have created a dangerous confidence that their models had accounted for essentially every meaningful risk. The presence of Nobel laureates on the team didn't prevent the collapse. If anything, their reputations may have made outside observers, and perhaps the fund's own leadership, less likely to question the fund's extreme leverage. As LTCM's losses mounted through the summer of 1998, the fund's exposure was so enormous, and so deeply interconnected with major banks around the world through complex trading relationships, that its potential collapse threatened to trigger a much broader financial crisis. In September 1998, the Federal Reserve organized a private bailout, coordinating a group of major banks to inject enough capital to unwind LTCM's positions in an orderly way, specifically to prevent the kind of chaotic, uncontrolled collapse that could have spread into the broader financial system. Robert Kiyosaki's core lesson about understanding exactly what risk an asset actually carries applies here at an institutional scale. LTCM's investors, and in some ways its own leadership, appear to have mistaken sophisticated mathematics for genuine safety. The models were technically impressive. What they couldn't do was account for a kind of risk that doesn't show up cleanly in historical data, the risk that everyone, everywhere, panics about unrelated things at exactly the same moment. Here's an honest complication worth including, since LTCM's story is sometimes oversimplified into a tale of simple greed or incompetence. The fund's core trading strategies, in isolation, were genuinely sound and mathematically well-reasoned. The failure wasn't really in the underlying logic of individual trades, but in the scale of leverage applied to that logic, and the assumption that markets that had historically behaved independently would continue doing so even during a genuine global panic. George S. Clason's advice about the danger of overextending yourself financially applies here on a scale Clason himself likely never imagined. LTCM's downfall wasn't a story about a bad idea. It was a story about a genuinely intelligent idea pushed to a scale of leverage that turned an ordinary market disruption into an existential threat, both to the fund itself and, briefly, to the broader financial system around it. This isn't a simple story warning against intelligence or sophisticated financial models. LTCM employed genuinely brilliant people using genuinely sophisticated tools. What makes this story worth remembering is the specific gap it exposed, the difference between a strategy being statistically sound under normal conditions, and a strategy being survivable under the specific, rare conditions that eventually determine whether extreme leverage destroys everything built on top of it. So here's a question worth sitting with. In your own financial decisions, is there a strategy you trust simply because it's worked reliably so far, without asking what specific, rare scenario could make all of that history irrelevant at once? Before you leave, I want to hear from you. Have you ever trusted a system, a plan, or a strategy simply because it had worked consistently for a long time, right up until the moment it suddenly didn't? Read a few comments before you go. some of the most sobering stories on this channel come from people who've experienced exactly that kind of sudden, unexpected failure themselves. Next week, I'll pick one comment and send its author one of the books that inspired this channel. And if these stories help you think differently about money, you'll find a way to support future research in the description. Every contribution helps buy books, access research, and keep this content free for everyone. Remember this. Long-term capital management didn't collapse because its math was wrong. It collapsed because even correct math offers no protection against the one scenario nobody built it to survive.